Welcome to MarketView with Ike Iossif and Friends. This show that not only reveals and analyzes the inside story on today's market news, but also uncovers the areas where investors can make money right now.
Good morning. Ike Iossif, your host for MarketViews. Today's guest, our good friend, Mr. Glenn Neely. Hi, Glenn. How are you?
Hey, Ike. Been a long time. Probably the longest we've ever gone without talking.
Yes, it has been, but I have to say, the last time we spoke, you did say something rather prophetic, because you had said at the time, and actually it was December the 18th, and you had said that, in your opinion, the risk in the equity markets was at one of the highest levels in history, and in fact, the market topped out a few weeks later and it hasn't looked back ever since. So I'm curious to hear your thoughts for next year, starting with the euro.
Okay, yeah, we'll leave the S&P for last.
Yes.
Well, the euro is something I've been waiting for the corrective decline off the highs of 2020 to come to an end. And I kept telling customers, until we see a rally bigger than all previous rallies since the high in 2020, that the bottom wasn't in. And finally we got this is a monthly chart. We got this violent move on the monthly chart that turned out to be bigger than all prior rallies, except the rally before the C wave at the high had ended. So I knew that indicated the bottom was probably in, which it turned out to be correct, and it made one more retest, about 50% back toward the low, but it didn't make a new low. And then indicated that if the pattern was really over, we now needed a rally even bigger than the first one, and it would dwarf all prior rallies. So by the way, this chart is 2 weeks behind, so it's actually gone even higher than this. This chart is showing the very beginning of this E-wave. It's probably the only time I've ever made a forecast with 4 different price time targets. It's just never had to do that before, but just the way the circumstances panned out. With very limited data, I'm having to approximate the size of wave E. The minimum size for wave E is probably about 61% of wave C. The maximum is just under 100% of wave C, because this appears to be a triangle and wave A is the biggest, which means wave E has to be the smallest. And then the timing is just taking the time of C and D and dividing by 2, which gives us the first vertical time period. And then C plus D equaling wave E gives us the second time period. So that's why there's 4 targets. It's the minimum target, the minimum time, the maximum target, maximum time, and all the other combinations. And the way it's moving right now is so fast that probably it's going to be the upper target, but I can't be sure about the timing yet. But at this moment, it looks like the upper target and the halfway time is possible, but we're definitely going to get above the minimum target, which is about 1.08. So that's definitely going to happen. It's just a matter of time. And we're not going to finish this pattern until about early 2024 is what it looks like. So it's going to be going up and sideways in the euro for quite a while.
In our last interview, you were also expecting gold to have one last rally and then enter into a bear market. What are your thoughts for gold for 2023?
The peak there, where it shows the V, C, and B after the high, I called that either right as it was happening or right after it happened, with the vertical drop that happened right after the VCB marking. And that was the beginning of the bear market. I indicated that if we had started the new bear phase, which I thought we had, that we had to break below the bottom of the B wave back in sort of mid-2021. And it had to do it in less time than the prior C wave rally took to form. And it did all that in the amount of time allocated, so it dropped quicker and further, confirming that we made a major top. So that's, to me, the beginning of a multi-year bear market in gold. A lot of people have a lot of trouble with this, I think, because they see the government printing tons of money, and Washington is just sort of drunk with spending trillions of dollars, and the COVID situation, all the money that was spent there. The collapse of cryptos maybe is making people think it should also go up, but I still think long term, and what I'm doing is I'm reverse engineering my opinion based on wave structure, because wave structure is clearly bearish. I don't create my wave counts based on what I believe. I create the wave counts based on rules and then I determine what the future must be based on what the wave count tells me is going to happen. So the wave count is definitively bearish for a long time. So I have to sort of figure out how that's possible. So I'm assuming that with the Fed raising interest rates, that's going to slow down the growth of the money supply. They're also pulling money out of circulation. What do they call that? Not QE, but reverse QE.
Quantitative tightening.
Yeah, there you go. So they're pulling money out of circulation, which is also increasing the value of the dollar. And when the dollar value goes up, it means things priced in dollars are going to go down, like gold. And I think that the crypto situation is getting rid of a lot of the con games and all the trivial, unnecessary, unusable cryptos, similar to what happened in the dot-com period where all you had to do was just create a name and you became famous and made lots of money. You did global.com and wham, you're a multi-million-dollar company. So I think that's what's happening in crypto, that all the con games are going to be washed out, all the useless cryptos are going to be washed out. There's only going to be a few left. I think after the dot-com crash, there was only like 95 to 99% of all the companies went out of business, and Amazon and a few others were left. I don't know the exact numbers, but it was a big, massive washout. I think that's going to happen with cryptos, but what's going to be left will be Bitcoin and maybe Ethereum and a few other big ones, and that's going to start the next, recovery in the crypto industry. And eventually, I still say long-term, Bitcoin will be the international world gold standard, that gold will be far less important because it's not as portable. Gold has the same qualities as Bitcoin. I'm not comparing it to any other crypto, but Bitcoin by itself is the only completely free, unregulated, uncontrolled by any company, sort of like the internet. It's just pervasive, but it can't be manipulated, it can't be corrupted, it can't be controlled. And it's super portable. So I think that over time, Bitcoin will become the international standard of value in replacing gold. Gold will become an industrial metal, but not so much a store of value for inflation and stuff. So this long-term trend, moving away from gold as an inflation head and toward Bitcoin primarily, I think is one of the primary reasons gold's not going to do as well going into the future. But along with, interest rates rising and quantitative tightening.
Okay, since you mentioned interest rates, what are your thoughts on T-notes? Last time we talked, you were pretty bearish.
This chart is out of date by a few weeks, so it has bounced more than what it shows on this chart. The blue scenario still looks like the primary scenario, but any break of 4.4%, like move beyond 4.4%, will activate the red scenario. So as long as we stay above the lows on this inverted chart, so in other words, as long as T-notes don't make new lows below this year's low, our interest rates don't go above 4.4%. As long as that remains the case, then I think the blue scenario is in effect. But any move beyond 4.4% or any new lows in T-notes below this year's low, I think the red scenario is in place. And I'm sort of borderline on which way it's going to go. It's a very tough call, and I'm very confident the stock market's going to be going down for the next couple of months. I don't know if that's going to be instigated by a big increase in interest rates. It's very hard to know. So I'm sort of on the fence. But maybe 55% in favor of rates moving beyond the 4.4%. But I think the best strategy for people who are, trading this market or watching it, that you would be currently either flat or short the T-note market. And then if it makes a new low, stay short. If it doesn't do it for maybe 6 months, then maybe get out of your short if you are short, or just stay out. I don't think being long is wise right now. It's just a little too dangerous.
And that brings us to our last chart. You just said you expect the equity markets to go down for the next couple of months. Can you elaborate further?
Well, this chart again is also a few weeks old, so it's a little out of date. We have rallied further, and that reinforces the idea that I've been saying for quite some time, that we're in the middle section since this year's high, that we're in the middle of a very large upward drifting, contracting triangle. Now, most Elliott Wave analysts will just think this is completely insane because this scenario is super bullish long term, not only for the next year or two, but super bullish long term. So this fits right in with my forecast in the back of my book made 35 years ago about where I was calling, when the Dow was around 1900, calling for the Dow to exceed 100,000. Now I think it's going to be more like 200,000 or 300,000, but at least it's going to exceed 100,000 somewhere into the mid part of the century. This count fits all the proper rules of not only orthodox wave theory, but all the additional rules I've added to wave theory called NEoWave rules. And the amount of scenarios we're currently dealing with are pretty decent. There's multiple different ways of interpreting this. When a market's open to lots of interpretation, it always indicates you're in the middle. So this count puts us right in the middle of a larger structure, so it's the best for that reason. It also follows all the rules of contracting triangle behavior. You can see the COVID crash is super violent, which is typical A-wave behavior in a contracting triangle. The C wave, as of the low in May, was right at 61% of wave A. The new low that we made, I think, is part of what I call supplemental price action, where it goes a little bit beyond the ideal target. And this always happens in one of the ways of a triangle. Normally, in a contracting triangle, it happens in wave A, but wave A didn't drop low enough to create it. So I think it saved it for wave C. So I think the low is now in for the rest of this year and the rest of probably next year. And then we're just going to retag, get close to those lows over the next few months, not break that low. And then we're going to start a major new run to new highs. And I'm going to pull up my long-term monthly chart here on my own computer. Let's see, that target would be somewhere. It's about 5,500 approximately. So that's where I think the S&P is going to go over the next few years. Let me give you a time on that. Okay, yeah, about 5,500. And I would give that to about, say, late 2023 to early or mid-2000. So let's say late 2023 to mid-2024 would be around the time we would reach that target. I'm going to have to do, more time calculations later once I can be sure the C wave is over. But that would be my visual approximation about where it might happen. So that's a pretty bullish outcome. And I'm sure you'd be hard-pressed to find any orthodox Elliott Wave people saying that.
I agree. Glenn, anything else you would like to add?
No, I guess that's about it. I do. If anyone who trades cryptos, I think we're getting really close to the point where getting back in that market could be, a good thing. The reputation and damage has been pretty severe, and that's going to probably continue for a while as the market bottoms out, which is all the way, the way markets always bottom. I think the best way for the crypto market to bottom, by the way, I don't do wave counts on crypto because they never make any sense, which is a little weird, but they don't. I think the best indication of the crypto market bottoming will be if the company MicroStrategy is forced to sell or go bankrupt, because they've been the biggest promoter and holder of crypto of almost any company in the world. And their average entry is around, I think, 30,000. So it's half of that, and they're quite a bit of money if it goes much lower. So I think if they can get wiped out or forced out, that'll probably be the bottom of the crypto market. But just wait for some more bad news, and if it gets really bad, I think that'll be the time to buy.
Glenn, thank you. Happy holidays.
Okay, you too. Thanks.